All right, so welcome to for this class, chapter 12, where we're going to be talking about corporations. And really, the main point of this chapter is to discuss stock transactions and dividends. But before we do that, we're going to segue into that with a discussion of the organization of a corporation, what a corporation actually is, those types of things. So we'll dispense with the learning objectives and get right to it. So we have some characteristics of a corporation. Very, very important to understand that a corporation is a legal entity. And this is true whether we are talking about a large publicly traded corporation or not, but it is distinct and separate from the individuals who create and operate it. So, because a corporation is a legal entity, it is allowed to conduct transactions orchestrated by people, certainly, that are very, very common and have a definite business nature. Uh, Acquiring property and debt, owning, disposing of property. Go back here, it says uh, corporations may incur liabilities, enter into contracts on behalf of the corporation. And it says here, most importantly, a corporation can sell shares of ownership called stock. I want to move back up to this second bullet point here. It says the corporation may also incur liabilities. Well, in our previous chapter, we talked about a type of liability called bonds. Bonds are a debt instrument, and so a corporation, if they can get people to buy the bonds, can raise money by taking on debt. But that is just one way that a corporation can raise money. The other way is to sell shares of stock, i.e., sell off part of the company into individual or group owners. And we call those individuals or groups stockholders, sometimes called shareholders, who own stock. I'm sorry, let's back up. Stockholders or shareholders who own the stock own the corporation. So this is an important little distinction here. Let's say that you go out today and you decide that you want to buy 3 shares of Netflix stock. 3 shares of stock in Target or whatever other company you think of. You buy those 3 shares of stock and you are a part owner of that company. And that's how it works. Now, you may say, well, yeah, but I'm really a small owner. Well, yeah, you might be, but you're still an owner. Whenever you buy stock in a company, you are an owner of that company. Corporations whose shares of stock are traded in public markets are called public corporations or public companies, sometimes also referred to as issuing companies. And then we also have corporations that are private and their shares of stock tend to be privately held. They're not available for the public to purchase. Most of what we're going to be talking about in this chapter are these larger publicly traded corporations. If you do decide that you want to buy stock in a company, there are some advantages. Stockholders of the corporation have limited liability. What that means is your risk is limited to what you have invested in the company. Um, Creditors cannot come after your personal assets. So again, you buy stock in Netflix, you invest $5,000, the most you can lose is $5,000. So that's kind of a good thing. You're not liable for lawsuits and those types of things. Uh, it also says here that stockholders control a corporation by electing a board of directors, and the board of directors are responsible for the day-to-day oversight of overall company operations, they establish policies, and you probably have heard of a CEO, a Chief Executive Officer, and these are what we call C-suite executives that make the big, long-term decisions to hopefully help the corporation attain their goals. So we've got a little diagram here, organizational structure of a corporation. The stockholders are at the top, and really outside of that, everything makes sense. The board of directors is higher than company officers, and officers are higher than employees. One thing I would point out here with the stockholders thing being at the top, um, this is in the aggregate. All of the stockholders together are above the board of directors. If you own your 3 shares of stock in whatever company, um, believe me, the board of directors is not even going to know you exist. So you can't, call up and make demands or anything like that. But stockholders are generally, for a large company, made up of some groups and some individuals who own large blocks of stock. And those individuals and groups do have significant influence over the company. Some disadvantages of a corporation, a publicly traded corporation, is that corporations have to pay federal income taxes on their income. As well, stockholders must pay income taxes on the dividends they receive. So let's say that you buy your 3 shares of Netflix, whatever, and you get a dividend check or the possibility of a dividend check for, let's just say, $32 on those 3 shares. Well, that $32 in dividends that you got from your 3 shares over the course of a year represents corporate earnings. So the corporation is going to pay federal income taxes on that $32. They're then going to distribute it to you as the stockholder, and then you are going to pay income tax on it through your personal federal income tax return, and more than likely your state income tax return. So we call this double taxation. Now, the rates that you pay and the rates that the corporation pay are probably going to be different, but we still call this is considered to be a disadvantage of the corporation form of business because of what we call double taxation. When we go to form a corporation, there are many formal steps that must be taken, and there are costs in the process that must be considered. Legal fees, attorneys are not cheap. We've got some taxes. These can be small figures, they can be very large figures. State and corporation fees are generally not too much. Licensing fees, generally not a major expense, but promotional costs and legal fees definitely can be quite costly. Of course, that's all relative to the size of corporation that we're going to embark upon. It says such costs are debited to an expense account called organizational expenses. And we've got an example here of how we would do this. It says to illustrate a corporation's organizing costs of $8,500 are recorded below. Well, we've got an expense here. So expenses are always debited, $8,500. And in this very basic example, we're paying this with cash. If you look through your textbook, you'll probably find some other examples of how we can do this and make it more complicated, but I'm not really interested in you understanding anything more than the fact that these organizational expenses are just that. They're going to become an expense immediately over on the income statement. So we're going to introduce this concept called paid-in capital from stock. And it says that the two main sources of stockholders' equity are paid-in capital or contributed capital and retained earnings. So let's just understand what these things are, just so we're clear on it. When we talk about retained earnings, these are the all-time earnings that a company has made that have been retained, that is, not paid out in dividends. So we made $100,000 last year. In our first year of operations, we paid out $10,000 in dividends to owners. Our retained earnings is $90,000. That's the part that we have retained. Paid in capital, contributed capital, common stock. There's a lot of different ways we can refer to this. Capital stock. These are owner investments by way of purchasing stock. You start a business. Back in Accounting 1, if you had me for that class, we used an example where a fellow decided to open up a business. He put $25,000 cash into the business account, and he received $25,000 in stock in that company. So these are the two main sources of stockholders' equity. And remember, if you ever want to know, if anybody ever asks you what is the main purpose of the balance sheet or what primary purpose does it serve, it shows us stockholders' equity at any point in time. Now, it shows us assets and liabilities, but what we're really interested in as owners is how much of that do we have a claim to, and we call that stockholders' equity. One more slide here. When we talk about stock, well, how does this happen? It is a formal process through the board of directors. And so we've got some terminology that we need to learn about, and we're going to actually learn about some more later in the chapter. But for now, let's say that a company is just getting started and they decide, the board of directors decides that we have a certain amount of money that we need to raise. And so we're going to authorize the sale of stock. And rather than worrying about what type of stock or anything like that, we're just going to call it stock for now. So the board of directors might get together and they say, you know what, we're going to authorize the sale of 100,000 shares of stock. So if we, in that situation, they make a formal action, they authorize the sale of 100,000 shares, we would say that the authorized shares equal 100,000. However, it is rare that the initial number of authorized shares is going to equal the shares issued. And this is generally done on purpose so that if we need to, we generally authorize more shares than what we really need to issue. So we authorized 100,000 shares, but we may only issue 60,000 of those shares. And what that means is, when we talk about issued shares, is these are the number of shares that we have actually sold to stockholders. So in this example, we now have 100,000 shares of authorized stock and 60,000 issued shares. These are, again, the shares that we've actually sold. And then finally, we have what we call outstanding shares. And let's look at this definition. It says outstanding shares are issued shares that are owned by stockholders. And you say, well, okay, well, who else would they be owned by? Wouldn't outstanding shares be the same as issued shares? Not necessarily. And we're going to get into this a little bit later in the discussion, but let's just say that, let's just take this example using the same numbers that we have been using. We might have 100,000 shares authorized, 60,000 shares issued to stockholders, but then sometimes the company will either retire shares by buying them back, or they will buy those shares back and hold them as what we call treasury stock. And we're going to get to that a little bit later, but let's just say that we had 60,000 shares issued, and then the company, regardless of what they're going to do with these shares, they buy back from their stockholders 5,000 of those shares. Well, we still have 100,000 shares that have been authorized. We still issued 60,000, but now there are only $55,000 that are outstanding. Okay, and I think that's good enough. We'll move on with another video after this one.